Devina Mehra joins us. Let's take our conversation forward. Chairperson and Chief Investment Strategist with First Global. Devina, good morning. Thank you for joining us. Uh, all I can say is that the bull run continues. And what is the best way to participate in this bull run? That is what I think everybody wants to know from you.
Good morning, Nikunj. So, last few times I have come on your channel, I have said this, that the markets, in the markets, it is now the risk is in not being invested rather than in being invested. And we've seen that. I mean, I've been saying that from March. Right now, actually, I have my view is like kind of in two pockets. So if I look at the large caps, that continues to be my view. As I've said before, while we have this figure of 15-16% compounding in equity, that varies very widely, not just from year to year, but even decade to decade. So if you look at the 80s, if you had invested 100 rupees at the beginning of the 80s, it would have become 700 by the end of the 80s. Whereas the 2010 to 20 decade, it went up only 2.3 times, barely beating fixed deposit returns. So there was a lot of room created for, and even if you look at this decade, we have only compounded some 12% because we had this very bad year of 2022 for the global markets in the middle. So it's not as if that you're way above the trend line and now there's like huge way to fall. So that the positive thing on the large cap side remains. As far as small cap and mid cap indices are concerned, they've had this, depending on which index you look at, 35 to 45% run since March without a correction. And that's where I see some reason for caution, because even a 5% correction in that index can mean 20% correction in individual stocks. And people again forget history, that how long these pockets of the market can give you pain. If you look at 2008, after that crash, that level came back, the small cap index in 2016. And even if you look at, and there was like a brief bull run in the middle, and then again from 18 to 20, you had again a 65% correction, which meant that 90% of the stocks were down more than 50%. So and also in all this, the index itself is also not very representative, because I was looking at how often the stocks in the small cap index, for instance, are churned, and it is like 18-20% in a year. So in 5 years' time, you practically have a new set of stocks. Some of them may have migrated upwards, that they're no longer small cap, but a whole lot more just go out completely. So that's the side of the market where I'd advise some caution. And I was looking at mutual fund flows. Most of the flows have been going towards the small cap end. So, that's the place where investors need to remain cautious. As far as the large cap side is concerned, of course, you have to pick the sectors, but overall, I still remain positive.
How should one look at railway, defense and shipyard companies? I mean, logically, what is the way to looking at them as an investor for someone? There are two scenarios which I get. Scenario number one, that these are euphoric stocks, P multiples the businesses cannot command this kind of an P multiple. So in your understanding, what is the right P multiple for some of the so-called defense and government dominated stocks?
Very difficult to come up with a PE multiple, the cuff, because especially I'm sure it will vary from company to company, because depending on the outlook for that individual company. We have bought some defense stocks off and on, but we always try to limit our exposure to things which are too uncertain, too risky. I mean, same thing with small cap. Even when you see momentum in the small cap, in small caps, you can get in easily, get out with much more difficulty. So we might go from 15% small cap to 20%, but we won't go to 40%. So, I mean, as I said, individually, some of those stocks which look good, we have bought, but as a pack, in fact, shipyard companies, etc., probably not even looked at that closely. Defense, as I said, we have bought, even globally, we bought at a point in time. So, I mean, I would be careful and also not get carried away by euphoria, because oftentimes, many times the announcements that you see and what actually happens in terms of numbers, there's a gap. So you have to go into each company quite deeply.
We've seen a comeback in IT and perhaps an underperformance in banks. If I look at IT, the situation is not scary, but it is muddled. If I look at banks, the outlook is crystal clear. What should one go? Go for this. Go for a sector where outlook is muddled but could change, or stay with banks where the outlook, at least in the near term, is crystal clear.
Well, I tell you what we have done. We have cut back on our bank exposure in our last rebalance. And I kind of disagree with you. Maybe not in the very near term outlook, but if you look at a longer term outlook, I would think the thing is the other way around, because as I've said often, maybe it is just a bias in my head that I am a nervous investor in banks, because I believe that you will always see more negative surprises than positive surprises in a lender. And that's one. And because and as an outsider, you can't even know when or where the negative surprise will come. That's one. And IT, in fact, has a great visibility if you look at a longer term perspective, because the fact is that the world is moving, digitizing more and more. There is more and more technology coming into non-technology companies also. So, there can be a small hiccup when your markets are not growing as much, and therefore, as I've said before, the sales cycle gets pushed. So something you think will, a deal that you think will close this quarter might take 2 quarters, but it eventually comes, and there is, I don't see great downside risk there. So, we're not heavily overweight IT, but still, that's a relatively outperforming sector as per our systems, especially some of the mid-cap IT names.
Okay, fair enough. I'm just curious to get in your take as well as to how you're reading into new age tech as a space, Devina. Given the fact that now we have seen a comeback or a turnaround of sorts, if you will, within this basket, would it merit a relook according to you? And what have you made of the progress made?
Yeah, you can look at it again. We haven't yet dipped our toes in it. Because now of course, always in such companies, it just because something comes down 50% doesn't mean it, or even 70% doesn't mean it necessarily becomes attractive. But some of the fundamentals are changing. We're keeping a look, but it has not become a thumping buy for us yet. So we haven't really gone into it. And as I said, our first step in the process is to manage the risk, and there are enough opportunities where the predictability is higher. So we have stuck to that.
Okay, fair enough. And I wonder if you've, had also a chance to get in a sense as to what's happening with some of these capital goods stocks, and given the fact that we are seeing the overall order momentum as well picking up, rail, defense, and the entire gamut, and in particular some of these capital goods stocks, what would be your outlook?
Capital goods actually is the one sector we were very heavily overweight for now 2 years. October 2021 is when we went overweight, and that has been consistently in this entire period one of our best performing sectors. So, people seem to have discovered it only in the last few months, but we have actually been evaluating every quarter that is the run over, because we've been invested in it that long. But till now, our systems have not signaled that the run is over. At times, we have, of course, switched stocks, booked profits, because some of those stocks went up 2 times, even 4 times. But we still remain, as of now, our systems still like it, and we still remain positive. Of course, you must also remember that it came out of a very long period of underperformance. So, this was a dog sector all the way from 2009 to 2021. So once we could see that the fundamentals were changing in terms of the order book and demand, and also because they had gone through so much pain, the costs were cut to the bone. So the companies were all lean, mean, and ready to take advantage of the uptick in the demand, and that has happened. So as I said, a considerable part has already played out. but doesn't appear yet that that run is over, and let's see how it goes.
Okay, Devina, great to have you on the show. Look forward to chatting with you. Glad that you could take time out and join in.
Thank you.